Hi there, I'm Khalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're diving into Netflix. Yes, the streaming giant that's been making us all lose sleep over cliffhangers. Did you know? Netflix went from mailing DVDs to having 300 million subscribers worldwide and dominating the streaming world with $39 billion in revenue in 2024. Now let's dive into their stock and see if it's as binge-worthy as their shows. We will break down Netflix using the 5 key factors to form an opinion on whether it is undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Before we dive into Netflix, don't forget to give that like button a little love, and if you're new here, subscribe to my channel so you never miss out on any future content. Now let's break Netflix down into our 5 key factors. For the first factor, we look for companies with high returns on capital deployed, preferably a return on invested capital and return on equity ratio that is above 15%. As this gives a strong indication of financial efficiency and future profitability. Netflix ticks the box with a return on invested capital of 19.2% and a strong return on equity of 38.4%. Both ratios have been steadily increasing over the long term, indicating that management is becoming more efficient at using capital for the most profitable opportunities. Next to that, we look for companies that are able to grow earnings. Netflix's revenues have grown with a compounded annual growth rate of 11.8% and 33.2% for net income over the past 5 years, which is very impressive. Growth in earnings per share is in line with net income, with a compounded annual growth rate of 34.1%, reaching $20.3 in earnings per share as of 31 December 2024. What's interesting is that the large jump in earnings per share from 2023 to 2024 was partly due to Netflix's crackdown on account sharing. While it upset many users in the short term, it ultimately drove a significant increase in paid subscriptions and higher profits, which is reflected in 2024. The big question is whether Netflix can keep growing worldwide, and the answer looks promising. Netflix breaks down its revenue by region, and the results are impressive. Every region is seeing double-digit growth. The US and Canada are growing with a compounded annual growth rate of 10.9%. Europe, the Middle East and Africa at 12.3%. Latin America at 11.3% and Asia Pacific leading with an incredible 16.8%. An important factor behind Netflix's profitability is how they manage their investments in new content like shows and movies. By comparing revenue growth to the cost of revenues, which mainly includes amortization of their content, we can see their disciplined approach. Netflix aims to keep growth in content costs in high single digits, while targeting revenue growth of 12 to 14%. And with an 11.8% compounded annual growth rate for revenues versus 8.3% for content costs, they're clearly staying on track with a strategy that drives margins and financial discipline. Now for the third factor, we look at healthy financials. Netflix has a total debt of $18 billion and $9.6 billion in cash and short-term investments. So Netflix is not able to fully pay off its debt with the existing cash. To determine whether Netflix has acceptable debt levels, we will look at their debt-to-equity ratio. Debt to equity was high in 2020, but this has significantly improved in the last 5 years, as it has gone down to 0.7 due to their strong profitability growth, which increases retained earnings and therefore total equity. For the fourth factor, we are going to look at the valuation of Netflix. Netflix is currently trading at a price-to-earnings ratio of 52, which is high compared to the price-to-earnings ratio of 30 for the S&P 500. But Netflix is growing at a much higher pace than the market, with a compounded annual growth rate of 34.1% for earnings per share over the last 5 years. According to super investor Peter Lynch, If earnings growth is lower than the price to earnings ratio, the stock might be overvalued. As we just saw, the earnings growth rate of Netflix is 34.1%, which is below the 52 price to earnings ratio and does not justify its current valuation. If we compare the valuation of Netflix to other tech firms with similar growth in earnings per share, the picture becomes more clear. In this chart we see Netflix with a compounded annual growth rate of 34.1%, Meta at 24.5%, Microsoft at 19.5% and Alphabet at 28.7%. Netflix is the clear winner in terms of earnings growth, but not from a valuation perspective, with a price to earnings ratio of 52.1 compared to 32.8 for Microsoft, 30.2 for Meta and 22.9 for Alphabet. A strong moat is key for future growth. It helps protect long-term profits and market share from competition. Netflix has built a strong moat thanks to its dominant brand, massive content library and global subscriber base. What sets Netflix apart is its original content, constantly feeding its binge-hungry masses. And let's not forget its first mover advantage. Netflix is the go-to streaming service for millions. Plus, their recommendation algorithm is basically a mind reader, keeping users glued to the platform while making it tough for competitors to catch up. This combination of exclusive content, global reach and data-driven tech give Netflix a major edge in the streaming wars. Netflix's global expansion is also a major strength, with a growing presence in Asia, Latin America and Europe. This worldwide reach helps them attract new subscribers, while also creating local content that resonates with international audiences. Their strong subscriber loyalty and content that appeals to just about everyone makes it difficult for new entrants to displace Netflix as the dominant player in the streaming world. But there are risks. One big concern is the rising cost of content. With all the competition, Netflix is spending big to secure exclusive shows. And if subscriber growth slows down, margins could feel the heat. Plus, the competition is fierce. Amazon, Disney and HBO Max are all investing heavily in content and global expansion. So Netflix's growth could face some serious competition as the streaming space gets even more crowded. Now, before we conclude on Netflix, you may have spotted in the charts shown in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. To wrap up, in my view, Netflix is currently overvalued based on the 5 key factors. Netflix has high returns on invested capital of 19.2% and a strong return on equity of 38.4%. Netflix is also showing healthy growth in all regions worldwide, with revenue growing at a compounded annual growth rate of 11.8% and earnings per share with 34.1% over the past 5 years. Netflix has acceptable debt levels, with a debt-to-equity ratio that has come down significantly from 1.7 in 2020 to 0.7 for fiscal year ending 2024. Unfortunately, the valuation is too high at this point, with a price-to-earnings ratio of 52.1, which is not justified by its growth in earnings per share of 34.1%. At a lower valuation, the stock could become really attractive, preferably at a price-to-earnings ratio that is equal to the compounded annual growth rate for earnings per share or lower. Netflix has a strong moat thanks to its dominant brand, exclusive content and first mover advantage, keeping users hooked with personalized recommendations. Their global expansion and local content make them tough to beat. But the rising content costs and fierce competition from Amazon, Disney and HBO Max pose risks to future growth. Let me know in the comments what you think. Overvalued or just getting started? Or maybe you want me to dive into another company. Thank you for watching and see you next time.